So with plenary session 3, my name is Casamatta, and I'm here to introduce our guest speaker, Christine Parlour. It's an honor and a pleasure. Christine Parlour holds the Sylvan Coleman Chair in Finance and Accounting at Haas School of Business in Berkeley, and she's also the co-director of the Berkeley Center for Responsible, Decentralized Intelligence. And just to give you a brief overview of her career, before joining Berkeley in 2006, she spent 9 years at Carnegie Mellon, and before that she obtained a PhD at Queen's University in Kingston. Now, in spite of her North American roots, I know that Christine Parlour has developed deep connections with European universities. She's been, over the years, a visiting professor at the London School of Economics, at INSEAD or Paris Dauphine. For some reason, you haven't been invited to Toulouse, but we're going to fix that, of course. She's a prominent finance scholar whose research has received a number of awards, like the Best Paper Award at prestigious conferences like the Western Finance Association or the Editor's Choice article at the Review of Financial Studies. Now, I don't want to enter the quantity competition here by telling you how many papers she has written. The answer is a lot. And more impressively, in the leading journals in finance and in economics in our profession. Now, along all these great achievements, what is truly impressive about her work, and she will hate that, but anyway, is the breadth of topics she has embraced over the year. Christine Parlour has amazing contributions in all areas of finance, from banking to market microstructure, asset pricing, and corporate finance, which is really remarkable. And as another example of her relentless curiosity is her keen interest, and I should say enthusiasm, for the domain of fintech. So in fintech, usually, you have two branches. One, is about how digital technologies allow to, find new ways to provide the standard financial services and what are the consequences for competition in the finance industry. And the other branch deals with the decentralized nature that these new technologies allow for. And the new asset classes like crypto or the new ways to organize exchanges that this decentralization allows for. And what is amazing is that Christine Parlour has been at the forefront of research in both branches of that fintech field. So today, she's going to focus on the decentralized aspects and discuss how decentralized exchanges can help us understand some fundamental features of the organization of exchanges, and in particular, the benefit of fragmentation. We are so lucky to have you here. The floor is yours, and we'll take a few questions afterwards.
Thank you. Thank you very much for that kind introduction. Sadly, I think the paper might be somewhat of a letdown after that, but it started off on a high note. I should say that this is joint work. I'm going to be talking about two papers, really, but this is joint work with Alfred Lehar and Marius 𝐤𝐤𝐬𝐤. Okay, so what is the whole point? What are we trying to do here? Sometimes there's so many details in decentralized finance in this new world. We don't quite know what we're thinking about. In this particular study, what we're trying to understand is we're trying to understand how this new market form, which is sometimes called an automated market maker, how it works. And we're interested in particular about what it tells us about the people who supply liquidity on markets. People who supply liquidity on markets are really important because they affect price impact, they affect the ability to trade, and so forth. And a natural question, if you're interested in liquidity supply, is why look at this automated market maker in this new form? There are a couple of reasons to think through and understand automated market makers. The short version is they are coming, and there's nothing we can do about it. So currently, they trade a huge amount of transactions, and I'll go through some of the volume figures just very quickly. They also seem to perform in some dimensions better than centralized limit order books, which we usually think of as being the paradigm of the successful liquidity supply model. The other thing to notice is that there's this push towards tokenizing real-world assets. And as you tokenize real-world assets, you suddenly move to an environment where maybe they're not going to be traded on the traditional exchanges with separated payment rails, clearing and settlement rails. Maybe they're going to be traded on automated market makers. So this is something that we should be aware of as people who are generally interested in finance. Okay? So, decentralized exchanges. This gives you some picture over time of trading volume on a whole bunch of different decentralized exchanges. They're all roughly organized the same way, even though they are competing venues. They sort of differ in things that look a lot like what we would call make-take fees. And as you can see, the dark line at the bottom is Uniswap, and that's going to be the one that I'm focusing on, and that's got the highest volume. I should warn you, whenever we talk about decentralized exchanges, people put dollar values, on the screen. And this is because there's no sort of natural numeraire. And so any kind of volatility you see in these volume pictures could be the result of exchange rate changes and could also be the result of changes in token flows. So just be aware of that and cautious when you're interpreting these data. One of the statements I made at the beginning was that sometimes these decentralized exchanges provide better liquidity or look better on some dimensions than centralized exchanges. This picture has got two components, pink and a blue. So the blue represents posted depth on various centralized limit order books that trade cryptocurrencies. And the particular cryptocurrency I'm looking at is the Ethereum USDC, which is a stable coin. So you can think of this as Ethereum US dollars. So the blue lines represent different exchanges and the amount of posted depth. The pink represents posted depth on an automated market maker, and the one that I'm going to be talking about. There are three different columns, and to some extent I'm going to be talking about the difference between those columns. But as you can see, the largest pink column is bigger than any of the posted depth on the other centralized exchanges. And so that's sort of one of the things to notice about these, perhaps the dimension on which automated market makers do well. Okay, so let's dig a little bit into what these automated market makers are for people who aren't familiar with them. So Uniswap, the one that I'm going to be talking about, is a set of what are known as smart contracts, which is essentially computer code that is sitting on top of the Ethereum blockchain. So it's computer code that anyone can interact with. Uniswap as a market consists of thousands of liquidity pools. A liquidity pool allows you to swap one type of cryptocurrency or token against another type of cryptocurrency or token. If you think about something like the New York Stock Exchange or the Paris Bourse, everything is done, there's a stock always traded against fiat currency. There is no natural numeraire in decentralized finance, and so there's no natural sense of a numeraire good that everything is traded against, so everything is done as bilateral swaps. Uniswap has three different versions that are actually quite different. Version 1, version 2, version 3. One of the unusual things about this world is that innovation happens by issuing a new version as opposed to one particular institution changing its rules. That's not how it works because everything on the blockchain stays forever, so new versions are iterated. So common to all the three versions is basically how they work. People decide whether or not they want to supply liquidity or demand liquidity. Those are two separate things on automated market makers. Transactions are automatically, the transaction prices are automatically calculated just as a function of the resting liquidity supply. Liquidity supply effectively determines the prices. In a way I'll make a bit more precise in a second. The payoff that liquidity suppliers get, they get no money from price impact. They get money from a percentage of the value of the trade that is executed against their liquidity supply. And in Uniswap v3, that's fixed at 30 basis points. But in v2, it's fixed as 30 basis points. In v3, people can actually choose the fee structure, and that's going to be what I'm talking about. So the specific innovation in v3 is this fee structure, and people can choose whether or not they supply liquidity in 1, 5, 30, or 100 basis point pools. Right? The other thing that's unusual about v3 is a concept known as concentrated liquidity. And in concentrated liquidity, people who are supplying liquidity can specify the price ranges at which they want to supply liquidity. So this is starting to look a little bit like limit orders, but complicated type of limit orders. Okay? So just a sort of brief digression about where prices come from. If you're supplying liquidity on this V2, you basically supply the two tokens that can be exchanged against each other. So think about a world where you're trying to exchange Ethereum against a random token, right? Somebody at some point, if they want to sell the token, are going to deposit it and take out Ethereum, or vice versa, they can deposit Ethereum and take out the token. So basically all trades just work by depositing on one side and taking out from the other. And so that encompasses buy and sells. The prices in these automated market makers are determined by some sort of function. V2 has got this sort of convex thing going on, and basically the larger the amount of the token that you put in, basically obviously the amount of Ethereum you get to take out, but at a diminishing rate. So effectively what this convex function does is it basically builds in a price impact that prevents people from taking too large a positions. As more people supply liquidity, this function shifts out, and that effectively makes the price impact for any fixed amount of tokens as being slightly attenuated, and this is how the market reaches equilibrium. I realize that's a huge amount of information to absorb if you're not used to automated market makers, and I apologize. Okay, so the last thing that I want to touch on was this concentrated liquidity that I said was different about V3. So on V3, instead of just saying I'm supplying liquidity and I don't really know where the price is going to go, you can specify I'm only willing to supply liquidity if the price is within these bounds, if the transaction price is within these bounds. And you can do arbitrarily complex things. You can basically say things have to be in a really tight band around where I think the common value of this asset is. They can be in a wide band around this common value, or they can be in a kind of a random allocation around this common value. So they look a lot like step limit orders, if you will. So there's a lot of thought and complexity that can go into how people actually post their passive liquidity on V3. Okay, so here we get to the economic argument. It's expensive to change or adjust your position on a decentralized exchange. And on V3, it's more expensive and fixed costs have a bigger role. How are we thinking about it? If you're supplying liquidity, so you're a liquidity provider, you have if you want to update or change your position, if you want to change your bands, you have to interact with the protocol that's sitting on the blockchain. In order to interact with the protocol on the blockchain, you have to basically get that transaction processed. So you have to go through validators. In order to go through validators, you have to pay a fee. This is essentially has got nothing to do with the exchange. It goes to the person who is recording the information. That fee is sometimes called a gas cost. So if you're liquidity providers, you're paying that fee. If you're somebody who is liquidity demanding, if you're trading, you basically interact with the liquidity pool. In order to trade, you also have to pay a gas cost, and basically that goes there again to these to these validators, and that's outside the exchange ecosystem. The final thing is anyone who interacts with the liquidity pool also transfers money or transfers value to the liquidity providers, and they do this in the form of the liquidity fee. This is how the liquidity providers are remunerated. They just get these fees. They're paid by the people who are demanding liquidity. Okay. So, how do these fees stack up? What do they look like? This basically is a proxy for the gas costs of interacting with Uniswap v3. Gas costs are kind of complicated. There's a whole nother little microstructure going on. People can bid higher or lower, but basically you can look at how much people are paying on average per day for some of the basic transactions that people do when they interact with v3, like putting on a position or minting a position. And so what this shows you is it shows you over time the variation of these gas costs. Gas costs get really big when there's a huge amount of congestion on the chain. This can be because somebody is issuing Bored Apes or doing other sort of silly NFT things, or it can come about for other random reasons. It's been declining over time, and the merge, which was essentially an update that provides more efficient processing, has led to a reduction in fees. But still, we get variation of this over time. Okay? All right. So after that incredibly long setup, where are we going to go? What are the results here? Basically, when we look at v3 and we look at people choosing where they're going to supply liquidity, where they're going to demand liquidity, we see a couple of things. In cases where more than one fee level pool is active, you basically have a split between really large liquidity providers and really small liquidity providers. Small liquidity providers basically choose a pool that gets higher fees but has lower fill rates. So basically they get less action or less volume, but per transaction they get more. The really large liquidity providers have much higher fill rates and they get lower fees. And basically what's driving this is the difference in the fixed cost of interacting with the protocol. The little guys, basically, per unit, are much more worried about the fixed costs, and so they choose something where they can effectively be a little bit more passive. The bigger guys, because they're putting on whopping big positions, are less worried about the fixed costs, and so they're willing to interact more frequently with the protocol. And it turns out that this segmentation can actually be a little bit efficient. And it can be a little bit efficient because by providing a secondary pool where people can supply liquidity, even if they're small, and do it on a more passive basis, they are less likely to compete with the larger guys, and so you essentially get more liquidity being provided. And if you think that the metric of a successful market is more liquidity being provided, allowing smaller, say, retail traders to come in can actually be a good thing. How much time do I have, by the way? How much time do I need? Oh, 5. Okay, let's go. Okay, let's go. Okay, so we have a model. You've always got to have a model. So what do? Basically, we're thinking about a stylized world where there is a token being traded and it has a fixed value. We're abstracting from information. It's not clear what information in this environment is because there are no cash flows, but let's just say there's this fixed value. And we're thinking about a world where there are liquidity providers and they differ essentially on how large the positions are that they're willing to put on. We're just doing this in terms of the examples I'm going to do. It's just in terms of a Pareto distribution. What does that mean? There's a whole bunch of little guys and a couple of really big guys. And so this captures the idea that you have hedge funds who are out there, not that many of them, but you have a small number of liquidity providers who essentially have crypto in their wallets and they want to get some return on it. So what are people doing? Well, basically, if you're in a world where there are two pools, one is a high-fee pool and one is a low-fee pool, if you're transacting small orders, you're always going to go to the low-fee pool. And if you're transacting, if you essentially run out of liquidity on the low-fee pool, or it's no longer advantageous, you're going to go to the high-fee pool. So what does this do? It basically says that if you have small and large, essentially liquidity demand arriving, they're going to first filter through the low-fee pool because it's cheaper, and then they're going to go to the high-fee pool if they have to. And what that means is you'll essentially get different fill rates on the different pools. Low-fee pool is going to have a higher fill rate, high-fee pool is going to have a lower fill rate because it only, essentially, orders there only get executed when you get a large arrival, okay? You can sort through what people's equilibrium decision is and the pool that they sort into, and what does it look like? Picture paints 1,000 words. So basically, if you're really small, you're not going to participate in this market just because the fixed fees are too much. If you're a little bit bigger as a liquidity provider, you're going to go to the high fee pool. And if you're really, really big, you're going to go to the low fee pool because you're putting on large transactions and you don't really worry about the fixed costs. Okay? Graphically, if you want to look at a picture of what the equilibrium looks like, it looks like this. The green guys are the guys who don't provide liquidity. The blue guys on the top are the ones who are in the high fee pool. And I guess that's sort of sienna color, they're in the low fee pool. Sorry? Or orange? Oh, it's not really orange, but anyway, that color, dark beige, are in the low fee pool. The difference in liquidity provision is also going to have give you different looks on what the pools look like. So if you look at the people who are in the low fee pool, they're going to be the people who have really high endowments. If you're looking at the high fee pool, they're going to be the lower fee endowments. And that's going to translate as well into the number of people who are applying liquidity in the different pool types. So you can sort of see how this equilibrium is going to work. It's got implications as well for trade volume. So I said that people go to the low fee pool first because, well, you know, it's the low fee. Sure enough, you're going to see a much higher trade volume in the low fee pool, and the people who are demanding liquidity are going to be the smaller people who are essentially retail traders. The high fee pool is going to have a lower trade volume, and the people who are demanding that trade volume are going to be the guys who are really, really big. They're the ones who are desperate and need to scoop up that residual liquidity. So it's a very, very simple framework, but it's got very natural implications for everything that you might see about volume, liquidity, who's providing, and so forth, okay? So the wonderful thing about the blockchain is that you can look at data. The data that you get from the blockchain is typically really, really bad. A lot of the commercial vendors aren't particularly well vetted. It's not standardized like equity data. And definitions aren't standardized across different protocols. It's really hairy. Luckily, the people from Uniswap actually supply data to the graph, and so those data are pretty good. We verified it with our own data, and we checked with the Uniswap guys, so we think it's okay. So what do we have? We just have a whole bunch of it. And basically, we can see different wallets. We can look at the transactions that they do, which pools they choose. We can look at people who demand liquidity. And so what do? We basically just go through and we get the bigger pools. There's always a whole bunch of weird little cryptos that nobody quite knows what they are. So we sort of throw those out, and we end up with really, really big pools. Okay? And so what do we see? Well, in some of the cryptos, you don't get fragmentation. All the liquidity concentrates on one pool. So that's sort of like the standard liquidity externality thing that we talk about. But if you have two pools, then you see significant differences. If you have a low-fee pool, the pool size is going to be smaller. If you see trading volume on the low-fee pool is going to be much bigger. High-fee pool is going to be smaller. So this is all consistent with this kind of sorting. You can dig down into the people who are actually supplying liquidity, and sure enough, the characteristics of the people who supply liquidity are all consistent with small guys going to the high-fee pool and big guys going to the low-fee pool. Right? So on the, it's my left, your left, the one at the top over there. The average liquidity mint, so the size of the transaction that's being put on, the low-fee pool is going to be much bigger. If you look at who's providing liquidity, so that's going down, the high-fee pool, there are many, many more unique wallet addresses that are providing liquidity. So this is consistent with small guys who are interacting with the protocol. What about average trade size? Average trade size on the high-fee pool is much, much bigger than the low-fee pool. And the daily trade count, on the low-fee pool, we get lots and lots of little trades. And the high-fee pool, we get every so often, we get these really big transactions. So there's very, very clear differences in liquidity supply and demand across these two different venues. Right? And you can dig a little bit more deeply into exactly what they're doing, how long it takes people to put on a position to take it off, or to take it off to come back on. The low-fee pool basically is much smaller on these two dimensions. Essentially, these are big people who are actively managing their positions. So let me conclude, because you've been very polite, but it might be time. So what have we learned here? Well, we've learned that everything that happens on the blockchain is hideously complicated, but so is market microstructure. And these decentralized exchanges or automated market makers are designed for passive liquidity provision. Because these are on a public blockchain, there is a fixed cost associated with that you have to pay to the people who are maintaining the infrastructure of the blockchain. And that effectively changes the incentives of different types of players to enter into any of these automated market makers. If you give people a choice, do you want to go to a high-fee pool or a low-fee pool, and both of those pools are active, you're going to see that low-fee pools are going to have different characteristics. They're going to have high trading volume, low aggregate liquidity, few large number of liquidity providers, very, very short liquidity cycles, things move really quickly. High-fee pools are going to have low trading volume, high aggregate liquidity, and these are essentially going to be retail traders who are supplying liquidity, and it's going to take a long time for the liquidity to get cycled through. Even though you have this fragmentation, it can be efficient. It can be efficient because this two-tier system essentially allows small liquidity providers to passively supply liquidity and get a return on their crypto. And basically, you increase the amount of liquidity supplied. And so it can be a good thing. Thank you.
I don't know if it works. Maybe we have time for one or two questions before the round table.
Good afternoon. I have two questions for you. What are the risks of liquidation pools? Could you prevent the risk with algorithm calculation? Second question. How do you rebalance liquidation pools? first question?
I'm apologize, I'm jet
The
lagged.
first question or the second question?
Both questions, actually. Could you?
What are the risk RESK of liquidity pool? Could you prevent the risk RESK with algorithm calculation? Second question.
Oh, sorry. So
Second question.
The risks associated.
Yes,
with these
yes.
tools? Yeah. So you know there are known unknowns and unknown unknowns. So when you're passively supplying liquidity, essentially what you're doing is you're allowing people to rebalance your portfolio in states where they think it's a good idea and you might not think it's a good idea. So for an individual liquidity supplier, that's something that they have to bear in mind. If you want to talk about systemic risks, we don't know yet. Oh, thank you. So in terms of systemic risks, what could possibly happen? I don't know, there could be a solar flare, there could be an EMP pulse from somewhere that could wipe out a huge amount of information. These are things that we don't know yet because blockchain hasn't been around for a sufficiently long period of time. That said, in terms of protocols that appear to be robust, Uniswap is incredibly robust because it's quite simple.
Thank you. I think we have another question.
Hi, thank you very much for the talk. I really like your paper, so it was not like totally new, let's say. My question is like, so does the behavior depend like on the volatility of the different pools that are fragmented, especially since like if you have different feet here, different amounts of ticks are activated in the environment. So actually, when you provide liquidity in one tick, according to the feet here, might be like multiple ticks, and usually it's different for the feet tiers. So also moving from one tick to the other, so like it's different according to the feet tier, and so like volatility would also then like I mean like the risk and the need for like rebalancing would change.
Yes. So you clearly have you know how V3 works. So in this paper, we're not interested in the optimal amount of concentrated liquidity or the liquidity position, and so we're abstracting from that. We're just saying conditional on a particular asset pair. What do we say about the specific choice between the two different fee tiers? So that the broader question of exactly how volatility, say, features into the success or the pairwise volatility affects a specific choice of tokens, that's sort of outside the paper. Yeah. So the large liquidity providers tend to supply more concentrated liquidity. They have a narrower band, we find. The smaller guys tend to do over a much wider band, and that's a function of not wanting to rebalance so frequently.
Thank you. We have one last question, but Christine will be at the round table after, so if you have more questions, you will ask them at that time.
Yeah, so thank you very much. Great talk. Just maybe an opening question for those who are not in DeFi. What do you think we learn from DeFi exchanges that could be useful for centralized exchanges? So are there some features that could be interesting to implement in centralized exchanges? What's your view on that?
So automated market makers might be interesting to apply to traditional exchanges, which we could do. I think one of the things is, since Larry Gloston's very famous Is the Centralized Limit Order book inevitable, people have sort of had this idea that this is the most efficient form of liquidity provision. You pool everyone together. And what we learn from this is that sometimes maybe you don't want to pool everyone together because essentially some of the liquidity providers are crowded out. And I think that's sort of useful. And if you think about things like make-take fees on traditional exchanges, typically the make-take fees actually go the wrong way, in the sense that they provide subsidies to essentially higher fees to the people who are providing large amounts of volume. And so maybe this tells you that an inverted fee structure or a slightly different one would actually be more efficient in providing liquidity.